Chapter 3. Equities don't outperform all asset classes all the time. Most investors don't understand that even though stocks outperform fixed deposits, unlike a fixed deposit, stocks don't hit all time highs every second. An argument that existing stock market participants provide to new and prospective investors is the ability of equity as an asset class to outperform all other asset classes over longer period of time. The phrase longer periods of time is however left alone, completely undefined, and is used just to enhance the attractiveness of investing in the stock market. While equity market do generate higher returns over other asset classes, these higher returns come in short bursts and without linearity when compared to income from fixed deposits or monthly salary credits. A young first time investor who is out to make a quick buck soon realizes to his dismay, of course, that stock markets don't work on timelines, and though the markets are generous in creating capital during a bull phase, it is also brutal in taking all of it back and some more during bearish times. The irregular nature of stock market returns have therefore encouraged a lot of people to look at gold, real estate, and fixed deposits as the other avenues of deploying capital. Why do most people put a house over investment? Most Indian investors have spent the last decade profiting from rising real estate prices, as the abnormal rise in home prices have given false sense of belief that no one loses money buying real estate. Real estate does well very only if there is a boom in the overall level of economic activities. But if the overall economic activities is in a slump, real estate follows suit. An investor who does not understand equities find real estate as the best investment option, but after he has bought his first house, a down payment with regular EMIs cramps him with very little surplus for allocation to equities. The key differentiating factor in real estate investment is that two houses in the same locality don't have variance in returns as much as two stocks in the same sector can have. So, the returns from a GMR infrastructure might be very different from the returns of a L&T, quite unlike the near similar return from two plots of land located at a small distance to each other. Furthermore, while buying a house, a person leverages himself 4 times by putting up minimum money upfront, which causes even small movements in real estate prices to get magnified, leading to large gains for the homeowner. On the other hand, not too many people leverage while investing in stocks. Real estate prices are not volatile as during a slowdown. Prices hold their levels rather than fall down. This is because due to the low level of mortgage penetration, sellers prefer to withdraw from the market rather than engage in distress selling, which creates a vacuum. Real estate owners therefore do not have to go through the same trauma as stock market participants who are marked to market for every trade that one unknown person executes with another. It is this lack of volatility due to the illiquid nature of real estate investment that encourages people to leverage a few times over their own capital. Investment in real estate is made with a large amount of absolute upfront capital, unlike investment in the stock market where an investor normally starts with a smaller outlay. While an investor will allocate rupees 5 lakh to stocks, he would put rupees 20 lakh as down payment for his home. So the initial amount at work is always larger for real estate. With stocks, the desire to take a partial profit will grow with every 15% rise in the price, whereas for his home, He does not sell a part of it just to bring down the cost of the balance portion. Transaction charges, registration fees, and other ancillary costs are always higher in real estate deal when compared to the charges for a stock market transaction, which subconsciously makes investors to hold onto their real estate assets for a bit longer than what they do for stocks. These things make the effect of compounding work in a better manner on a real estate investment when compared to that on stocks. Finally, there is a peace of mind in not issuing rent checks at the beginning of every month and having what people like to call as their own home. But stocks lack the feel good. Moreover, the women folk at home can relate much better to a home than they can to a stock market investment, which quite strongly swings the deal for home as a first investment. Even though buying a house binds the investor into an asset class that compounds at a rate lower than that of a carefully chosen set of stocks, it comes with a dose of mental peace, as very few home buyers lose 70% buying a house on 4 times leverage, while there might be a few who have lost that and more betting on stocks even without leverage. The easy way to be the easy way to live a life is to let the first investment be a house, and the simple way to make wealth is to put the first investment in a group of stocks and allow more time for compounding. No timeliness in stocks. While there are no stipulated timelines to make gains from stock market investing, the duration of bull and bear markets can extend to periods that are totally unexpected. History has shown that while bull markets last for shorter periods of times, bear markets last for longer duration. In some cases, the bearish times may last up to 25 years, as it did in the US post the 1929 crash. In the Indian context, the Sensex went nowhere for 11 years post the Harshad Mehta bull run of 1992. While returns from equity comes to an investor in bunches, these returns are expressed in terms of compounded annual growth rate in CGR, which is just an effective way of smoothing out the abruptness of these returns. While smaller portfolios are generally capable of generating a higher CAGR when compared to large sized portfolio, the challenge of making superior returns over longer periods of time gets magnified by the nature and character of companies available for investment. Over the last 20 years, 80% of all listed stocks in India have failed to beat inflation, while during this period, more than 50% of listed Indian companies have failed to deliver even a positive nominal return. The time period in which equities outperform all asset classes varies and fluctuates depending on a host of factors, which includes the behavior of indices preceding the computation period, the valuation of stocks at the start of the period, and the stream of earnings growth, which is an outcome of the overall level of economic growth during the given time span. Consider a US investor who entered the market with the Dow at its September 3, 1929 peak. Subsequently, the Dow suffered 89.2% decline to 41.22 on July 8, 1932, thus erasing the previous 33 years of gain, as the US GDP contracted by more than a quarter, and the high valuation of the 1929 peak came in for a serious and severe reality check. It took 25 years for the Dow to reclaim its 1929 peak of 381 points. In fact, if someone had bought the Dow at the peak value in the 1929, he is now getting 15,780 in November 2013 for it. The resultant CAGR for all these effort exclusive of dividends has been 4.5% only. On the other hand, if someone bought the Dow in 1932 from its lowest level of 41.22 points, the CAGR would have been 7.62. Clearly, in an environment where most fund managers fail to beat the Dow or the underlying index, equities isn't such a blockbuster asset class that promises to change lives, create retirement funds, and generate surplus in a fashion most investors think it to be. Many argue about the brilliance of catching the 1929 bottom, while the rest would debate about the folly of catching the top. But we are just discussing thoughts here, which is necessary for us to understand the complexity of the business. Similarly, the Dow Jones went nowhere from 1967 to 1982, where for 15 years it fluctuated in a range. Thereafter, from a nominal value of 777 on August 1982, it rose more than 15 times to reach 11,722 points by January 2000. This 15-time move in the Dow came without any major drawdowns, except for the severe crash of October 1987, when the Dow fell 22%, its single largest daily percentage loss in history. One can envy the investor who bought the Dow in 1982 and stayed invested for the next 18 years, or pity the one who entered the market in 1967 and stayed invested for 15 years before booking out in 1982. Clearly, returns in this market have never been linear, but equity as a product is sold as one where an investor is expected to make money year on year. In reality, money is made in bunches for some years and lost in the others, and the residual of gains over losses is converted to a CAGR format and sold to investor as dreams. Focused portfolio works best. In spite of the data presented above, it is not unnatural for a few investors to keep outperforming all asset classes by buying a select group of stocks from sectors that are doing well during that period of time by having focused portfolio approach. A focused portfolio approach is one where an investor chooses a few stocks from a handful of sectors and tries to beat the indices and other asset classes over a longer period of time. Merely buying the index isn't enough, more so in India, where the index itself is market cap weighted instead of being price weighted as it is in the USA. A market cap weighted index remained skewed to a few stocks and also distorts returns for the investor. So, while index investing worked in US, it might not be that profitable a strategy to follow here in India. Even in the BSE Sensex, the top 4 stocks TCS, Reliance, ONGC and ITC make up for almost 30% of the weight, whereas the bottom 26 stocks contribute to the balance 70%. An investor who goes for index investing is therefore subconsciously concentrating his portfolio even while the index optically gives him a sense of diversification. Individual investors have an edge over mutual funds. It is easier for a serious investor to beat the market than it is for a mutual fund, as an investor who focuses on stock can pick and choose his opportunities without help from the general market. A mutual fund, on the other hand, has to diversify, have some of everything, protect their NAV from large abrupt fluctuations, and buy more of a stock from a sector in despair to align their portfolio weight with the overall index weights. They also have to focus on liquidity requirements to meet urgent redemption requests. An individual investor has no such compulsions. All he has to look for is the next best opportunity and then load up to the point of maximum comfort. The Indian story. The sharp rise of the Sensex from 676 points on February 1990 to 4,400 points on April 1992 had booked in years of gains ahead, and the broad Indian market traded sideways after that for the next 11 years till 2003. Similarly, the Sensex moved several times between 2003 to 2008, creating many multi-baggers and millionaires. On the way, post the January 2008 all-time high, the Sensex has gone nowhere for the last 6 years. Even as many of the investors' darling of the 2008 bull run continues to bleed at between 80% to 95% of their January 2008 peak. Investors who run away from the bear market generally aren't around to receive the gains when the bull comes along. While it is true that the index provides abnormal returns in bunches, the average return that the Sensex has generated since launch has been 15-16% exclusive of dividends, which is better than all asset classes but not enough considering the heartburn and the sleepless nights that an investor had to put up to generate these returns. Even while the Sensex did nothing between 1992 and 2003, there were stocks like Infosys which moved up a few thousand times. Infosys wasn't alone, as an entire range of stocks from technology, pharmaceuticals and FMCG business returned back large, above average sized gains for investors who were smart enough to catch the underlying market theme. Similarly, in the post 2008 phase, while the Sensex has gone nowhere, stocks like TTK Prestige, Page Industry, Grove Finance, Hawkins Cooker have rallied from 10 to 35 times and are still rising. There was money to be made even if the Sensex was going nowhere, as was observed both during the technology bull run of the 1990s and also during the recent rise in consumer, pharmaceuticals and private financial stocks. However, despite the tremendous rise in the Sensex from 2003 to 2008, Indian equities have over the last 11 years underperformed gold. During 1992 to 2003, where the Sensex did nothing, even a nominal 12%, that was the interest rate during that time, bank fixed deposits beat the Sensex hands down. From the highs of 1992 till now, the Sensex had returned a CAGR of 7.5%, which is lower than fixed deposit. If this is not long-term underperformance, then what it is? The Sensex has since inception beaten all asset classes, but the coupon on bonds for the first 20 years of this time span was close to 14%. So the risk premium hasn't been high. 33 years is the elusive long term that a person wishing to buy a diversified set of business, that is Sensex, has to wait if he wants to beat all asset classes. Interestingly, these 33 years have seen extraordinary bouts of money making with multiple stocks turning out 100 baggers, from Colgate, HUL, TCS, Nestle, Hero, Motocorp, Sun Pharma, ACC, Tata Steel, Infosys, GTV, Wipro, HDFC, Bharti, Pantaloon, Unitech, Titan, Page Industry, etc. Trying to bet on select group of stocks have made money like bandits, which emphasizes that it has always been a stock picker's market instead of it being a broad-based investment game for anyone wishing to make money, not just in India but across the globe. Stock market returns are not linear. From 79 to 84, 14%. 84 to 86, 109%. Then 86 to 90, 0.7%. Then 90 to 92, 139%. Then 92 to 2003, 0.1%. Then 2003 to 2008, 33.65%. January 8, 2008 to 2013, 0.4%.